Mortgage rates just dropped big time. Here's the real question. Does this mean lower payments are here to stay, or are we about to get faked out again? On Friday, the jobs report landed with a thud. Unemployment ticked higher and investors shifted their bets. Rates fell fast. And what happened? Refinance applications spiked immediately. I even pulled my Facebook community and heard story after story of buyers jumping back in. Homes that had been quiet suddenly had multiple offers. This tells me something powerful about the market right now. Let's unpack why rates fell, what could move them next, and what this means for you as a buyer or a homeowner. The U.S. just added 22,000 jobs in August. That is less than a third of what economists expected. Now, on top of that, June's numbers were revised down by 13,000. July barely held positive, and unemployment crept up to 4.3%. Markets translated this into a weaker labor market, a slower economy, and therefore lower interest rates. Mortgage News Daily had rates dropping to 6.29% within hours. And this isn't just a chart move. Applications to refinance jumped, and real buyers felt it. Some properties that were sitting saw multiple bids, and listings that were quiet went under contract over the weekend. That's what pent-up demand looks like. Even a small dip creates action. Rates didn't just drop because of jobs. They slid because investors shifted mortgage-backed security buckets. Think of it like this. Mortgages get bundled into coupons. The 5.5% coupon, which covers rates up to 6.625%, was losing steam. Investors shifted into the 5% coupon. That covers loans up to 6.125. Now, when that happens, rates don't just ease, they slide faster. And that's what you saw in the quick move on Friday. Investors want certainty that they'll get paid longer, and the lower bucket gives them that when they believe rates are headed down. Now, the Fed is center stage. After 2-week job reports in a row, a September rate cut is certain. But here's the problem. Inflation isn't dead yet, and the Fed's independence is in question. Last week, Stephen Moran, nominated to replace Adriana Kugler at the Fed, admitted in Senate questioning that he was only on a leave of absence from his White House job. Add that to the firing of Lisa Cook last month, and the markets are asking, how independent is the Fed really? Especially if Moran's expecting to go right back to his administration job. Why does that matter? Because if the Fed is pressured to cut too aggressively, inflation could heat back up again, and long-term bond yields, which drive mortgage rates, could climb. Two things matter most right now: inflation reports and the Fed's September 17th meeting. If CPI and PPI both show inflation re-accelerating this week, we could see bond yields jump, even if the Fed cuts. That's the paradox. Short-term relief doesn't always equal lower mortgage rates. But here's what Friday taught us. Buyers are waiting on the sidelines. Even a modest dip lit a spark. Imagine what happens if rates dip into the 5s. That's when demand surges. Bidding wars reappear, and ironically, affordability doesn't improve. It gets tougher. Let's zoom in for a minute. In my local area of Denver, inventory dipped 1.9% last week, but that's still 25% higher than last year. Pending sales slowed. Price cuts are still common, but sellers are getting a little bit smarter. Homes priced right are selling in 48 days versus the 115 days for homes that need price cuts. Now, nationally, rates are brushing year lows, but spreads and Fed policy are holding us above 6%. Analysts say that we need a weaker economy or a more dovish Fed to get below 6% for any length of time. So yes, the market is soft, but that's creating leverage for buyers through concessions, buy downs, and negotiating power. Here's the bottom line. Friday's job report gave us a glimpse of what lower rates unlock. Refinances spiked and buyers jumped. But the Fed's balancing act with inflation means we won't see a straight line shot in the 5s. Not yet. 2025 will continue to be sluggish. Possibly 4.1 million sales nationwide. That gives buyers something rare: time, leverage, and options. So don't just watch the headlines, watch the reactions, because this market rewards strategy, not waiting. So if you're wondering what this means for your plan, hit that link in the description and let's run your numbers. I'm Nicole Rueth, and I'll see you next week.